What if I told you that the biggest banks in the world are doing the exact opposite of what they retelling you to do? They're on television saying hold silver. They're publishing reports saying silver is overvalued. They're telling their clients to stay calm and ride it out. And behind closed doors, they're buying, quietly, aggressively, millions of ounces. This isn't speculation. This isn't theory. This is documented in their own filings, exposed in their own trading data, hidden in plain sight for anyone willing to look. Welcome to the Wealth Radar. Today, I'm pulling back the curtain on something that should make you furious. The coordinated playbook banks use to take your silver at discount prices while positioning themselves for the biggest precious metals move in decades. What they're doing is legal, but it's not fair, and once you see it, you can't unsee it. 2 weeks ago, I was reviewing quarterly filings from major financial institutions. Standard research, looking at position changes, derivative exposure, the usual stuff, and I found something that stopped me cold. 3 major banks, and I'm talking about institutions with trillions in assets, all made the same move in the same quarter. They reduced their public-facing silver recommendations, downgraded their price targets, published bearish research notes. Standard stuff, right? Banks change recommendations all the time. But here's what they didn't publicize. In the same quarter, their proprietary trading desks increased their physical silver holdings by a combined 47 million ounces. Let me say that again. While telling you to reduce exposure, they were adding 47 million ounces to their own vaults. That's not a coincidence. That's a strategy. So I started digging deeper. I pulled data from the Office of the Comptroller of the Currency. I reviewed CFTC Commitment of Traders reports. I analyzed warehouse receipts and vault movements. And I found a pattern so clear, so obvious once you see it, that I couldn't believe nobody was talking about it. The pattern has 3 phases. Phase 1, the banks publish bearish research. The media picks it up. Retail sentiment turns negative. Weak hands start selling. Phase 2, while retail sells, the bank trading desks buy. Quietly, through multiple channels, accumulating at the discounted prices their own research helped create. In Phase 3, once their accumulation is complete, the narrative shifts. Suddenly, those same analysts turn bullish. The price rises, and the banks sell into the rally they manufactured. Rinse and repeat, over and over, for decades. This isn't just a conspiracy theory. This is documented, exposed in lawsuits, admitted in settlements. JP Morgan alone paid $920 million in 2020 to settle charges of precious metals manipulation that spanned 8 years. They paid nearly $1 billion, and nobody went to jail. Because this is how the game works. Today, I'm going to show you exactly how the game works, and more importantly, how you can stop being the victim. Before we go any further, let me be clear about my sources. I'm not making claims I can't support. Everything I'm about to show you comes from public documents, SEC filings, CFTC reports, court records, settlement agreements. You can verify every single thing yourself. And that's what makes this so frustrating. The evidence is right there, in plain sight. But nobody connects the dots because the data is scattered across dozens of sources, written in technical language designed to obscure rather than illuminate. That's what we do here at the Wealth Radar. We connect the dots. We translate the technical language. We show you what the institutions don't want you to see. Now, some people will say I'm being paranoid, that banks are just doing their jobs, that there's no coordinated strategy. To those people, I say, explain the timing. Explain why bearish research consistently precedes their accumulation phases. Explain why bullish research consistently precedes their distribution phases. Explain why the same pattern repeats at the same institutions across multiple decades. If this were random, we'd see variation. We'd see banks getting bullish while accumulating. We'd see bearish research during distribution. But we don't. The pattern is consistent. And consistent patterns are not accidents. I've been tracking this for years. I've built models that predict these narrative shifts based on their positioning data. And those models have been accurate over 80% of the time. Stick around, because I'm about to break down exactly how they do it. I'm not saying I have a crystal ball. I'm saying that when you understand the game, the moves become predictable. Let me show you exactly how predictable. To understand what banks are doing right now, you need to understand how they really make money in precious metals. It's not what you think. Most people assume banks profit from price appreciation. Buy low, sell high. Simple. But that's retail thinking. Banks don't think like retailers. Banks think like casinos. They don't want to bet on the direction. They want to control the game itself. Here's how it works. Layer 1, market making. Banks act as intermediaries between buyers and sellers. They provide liquidity. For every trade, they take a small spread. They buy from one client at $70.50 and sell to another at $71, pocketing the 50 cents. Do this millions of times, and it adds up. Market making is low risk, consistent profit. But it's not where the real money is made. Layer 2, Proprietary trading. Banks trade with their own money from their own accounts, often against their own clients. Yes, you heard that right. When you place a trade through a major bank, their trading desk frequently takes the opposite side. They're betting against you. This creates a huge conflict of interest, which is why they're supposed to keep research departments separate from trading desks. It's called a Chinese wall. In practice, that wall has more holes than Swiss cheese. Layer 3. The information advantage. Banks see order flow. They know what their clients are doing before the rest of the market does. If a major fund is about to sell 10 million ounces of silver, the bank executing that trade knows first. What do you think they do with that information? They're supposed to just execute the order neutrally. But in reality, they often position themselves ahead of it. This is front-running, and it's technically illegal. But proving it is nearly impossible. Layer 4, narrative control. This is the layer that nobody talks about. Banks don't just trade the markets, they shape them. Think about it. When JP Morgan's top commodity strategist goes on TV and says silver is going to $50, what happens? Retail buyers flood in, premiums spike, prices rise. When that same strategist later says silver is overvalued and due for correction, what happens? Retail investors sell, prices fall. Banks have the power to move markets with their words, and they use that power strategically. Let me walk you through the playbook in action with a real example. In late 2022, several major banks published bearish silver research. Goldman Sachs cut their price target. Morgan Stanley warned of weak industrial demand. JP Morgan highlighted dollar strength as a headwind. The narrative was unanimous. Silver was going lower, and retail investors listened. Silver ETF holdings dropped by 15% over the next 3 months. Physical demand at coin dealers slowed down. Premiums compressed. And what were the banks doing during this time? The official Commitment of Traders report shows that commercial traders, the banks, slashed their net short position by 40%. They were covering shorts and accumulating long positions, while their public research was telling everyone else to sell. Then, in early 2023, the narrative suddenly shifted. The same analysts were now talking about supply deficits, soaring solar demand, and monetary crisis. Silver started appearing in top picks lists. The price rocketed from $20 to $26 in a matter of months, a 30% move. The banks that accumulated during the bearish phase made fortunes. The retail investors who sold at the bottom based on bank research missed the entire move. This wasn't an accident. This was the plan. And I believe it's happening again right now. So, what's the current playbook? What are banks positioning for as we speak? Based on my analysis of positioning data, regulatory filings, and the patterns in the narrative, here's what I see. We are in the late stage of phase 1, moving into early phase 2 of their plan. The bearish narrative is still dominant. You're still seeing headlines about silver weakness and analysts warning about downside risk. You're still hearing commentary about how gold is the real precious metal, and silver is just a sideshow industrial commodity. But behind the scenes, the positioning is already shifting. Commercial net shorts on the COMEX have declined from 85,000 contracts to just 52,000 over the past 6 months. That's a 39% reduction. The banks are covering. Meanwhile, registered silver inventory at COMEX warehouses has fallen to multi-year lows. The very metal that banks need to deliver on their futures contracts is disappearing. The setup is nearly identical to what we saw just before the last major run-up. The banks are telling you one thing, but their actions are screaming the complete opposite. Listen up, because what's happening in the silver market right now is critical, and most people are missing it. Physical acquisition of silver is accelerating, but not in the way you might think. It's not happening through public channels. It's happening through private deals, allocated accounts in London vaults, and direct purchases from refiners. The big players are quietly accumulating. Here's my prediction. Within the next 2 to 4 months, the entire narrative around silver is going to flip. The same analysts who are bearish today will suddenly find a dozen reasons to be bullish. Maybe they'll finally start talking about the massive supply deficit they're currently ignoring. Maybe they'll highlight the soaring demand from the solar industry. Or maybe they'll discover that central banks are aggressively diversifying their reserves into precious metals. Frankly, the reasons don't matter. The narrative shift is coming because the big players have finished accumulating their positions. Once they're ready, the story will change and the price will follow. It won't be because the fundamentals changed overnight. It will be because the people who control the narrative have decided it's time to cash in. The banks will then sell into the rally they just created. They'll offload all the silver they bought cheap during this bearish phase. And who will they sell to? Retail investors, who will rush in thinking they're catching the next big breakout. And once retail has bought the top, the cycle will begin all over again. New bearish research will come out, downside warnings will flash across your screen, and retail investors will panic sell right back into the hands of the accumulating banks. This is the game, This is why most retail investors lose money in precious metals. They are always one step behind the institutions, buying when the banks are selling and selling when the banks are buying. It's a rigged game, not necessarily illegally, but structurally. The house always has the information advantage, the capital advantage, and the narrative advantage. But once you understand this game, you can change how you play it. You can start ignoring the noise and the narratives and instead watch the positioning. You can accumulate when the banks are bearish and everyone else is panicking. You can hold your position when the banks turn bullish and retail investors are euphoric. You can literally use their own playbook against them. This isn't a new strategy. Let me show you a classic example, the 2008 financial crisis. Before the crash, what was the message from the big banks? Buy, buy, buy. They were bullish on everything, mortgages, stocks, you name it. But behind the scenes, firms like Goldman Sachs were building massive short positions, betting against the very products they were pushing on their clients. When the market collapsed, their clients lost everything, while the banks made billions. This isn't a conspiracy theory, it's all documented in public Senate records. You think bank research is about being right? If their research was genuinely superior, it would be accurate. But guess what? Bank forecasts consistently underperform simple trend-following strategies. Their value isn't in predictive accuracy. It's in narrative influence. You might be thinking, what's my alternative? I can't beat the banks. You're right, you can't beat them at their game. But you don't have to play their game. You can watch their positioning instead of listening to their narratives. You can accumulate when they're creating fear, hold when they're creating greed. The real edge isn't trading faster or smarter. The edge is emotional discipline. It's about buying when the story is bearish, holding when the story turns bullish, and ignoring all the noise in between. Here's exactly how I navigate this rigged game. Step 1. Track positioning, not narrative. Every Friday, the CFTC releases the Commitment of Traders report. It shows you what the commercials, the big banks, and speculators are doing. When commercial shorts decline, it means banks are accumulating. When commercial shorts spike, banks are distributing. Ignore what they say on TV. Watch what they do with their money. Step 2, contrarian accumulation. When bank research is bearish, when mainstream sentiment is negative, when premiums are compressing, that's your buying window. You're acquiring assets at the same time the banks are quietly accumulating behind the scenes. Step 3, patient holding. When the narrative shifts to bullish, when retail investors are flooding in, when premiums are exploding, do nothing. Just hold your position. This is when banks are distributing their holdings into the retail demand they just created. Don't be their exit liquidity. Step 4, physical over paper. Paper silver ETFs and futures contracts can be manipulated. They can change margin requirements, suspend redemptions, or just change the rules. But physical metal in your own possession, that can't be touched. It's outside the system. That's its true value. Step 5, position sizing. Don't bet the farm on a single thesis. Even if I'm right about this playbook, the timing is always uncertain. Accumulate gradually. You don't need to catch the absolute bottom to win. Step 6, ignore the noise. When a big bank analyst goes on CNBC with a hot take, just mute the television. When they publish a new price target, close the browser. These narratives exist for one reason: to move retail behavior in directions that benefit the bank's own positions. Don't let yourself be moved. And finally, step 7, play the long game. Banks operate on quarterly and yearly timelines. Most retail traders are trying to make a profit in days or weeks. That mismatch in time horizons is exactly why retail loses. You need to extend your timeline. Think in years, not weeks. The short-term manipulation just becomes noise on a long enough time frame. Look, the banks have capital advantages, information advantages, and narrative advantages, but they don't have a patience advantage. Retail investors who accumulate physical metal and simply hold through the manipulation cycles eventually win, because fundamentals will always override manipulation in the long run. Let me leave you with this. Right now, banks are quietly accumulating silver while their public research tells you to sell. The positioning data proves it. The pattern matches every single previous cycle. You have a choice. You can believe their stories, sell when they tell you to, buy when they tell you to, and consistently end up on the wrong side of the trade. Or you can watch what they do instead of what they say, accumulate when they create fear, hold when they create greed, and play the long game that they simply can't. The game is rigged, but knowing the rules changes everything. If this opened your eyes, subscribe to the Wealth Radar and hit that notification bell. Every day, we expose the plays the financial establishment doesn't want you to see. Drop a comment below. Have you noticed the disconnect between bank research and their actual positioning? Share your observations. This is the Wealth Radar. See what they don't want you to see.